Okay, very good morning to everyone. This is going to be the briefing for the 16th of March. Happy Friday to everyone. Point of caution before I start, this is quadruple witching today. So this can cause volatility, which is quite erratic at times in the market. So if during the briefing you do start seeing some erratic movements, just be a bit careful. I'll talk about what sort of markets are going to be affected by it, but the main talking point of today will be sort of the two distinct phases we saw in the US equity market and the dollar in the beginning of this week, and how that correlation changed in the latter part of this week, and looking at the sort of reasonings behind it. So if we start off having a look at the charts here, I'd like to just talk about the dollar to start with. If we have a look here at the start of the week, we saw after the ECB event where we saw the dollar weaken coming into this part of the week. This is Monday marked up here, and on Monday we can see sideways price action, then breaking out of a range and finally rallying, and this was on the back of this political instability we're seeing from the United States with Gary Cohn, first starting off with Gary Cohn resigning, then Rex Tillerson getting his surprising resignation. This dollar weakness was then followed suit by a bit of equity downside. Let me just put on the S&P 500. So economic instability causing the equity market to find some pressure here on Tuesday, continuing its downwards trend, quite technical. On the next point of note then, as we can see, the equity market stayed subdued yesterday, largely range bound, trading sideways. This was coupled with, however, the dollar finding a bit of strength. So this is one of those situations where both we can see dollar weakness and equities moving lower or staying under pressure, given the fact that we have some economic instability, plus then we've also got the fact that the dollar and equity market moving inversely at the same time. And this dollar strength that we saw on the maybe a Thursday, yesterday, and probably today as well, was due to Larry Kudlow stepping in and saying that they would sell gold to buy, what's the beautiful greenback? Let me just bring up the article over here so we can get the exact wording here. We transition across. Selling gold and buying King dollar, sorry. And as you can see, we saw the dollar strengthen quite significantly here. This was also shown in the gold market. As you can see, gold coming under pressure. This is the economic advisor now to Donald Trump, saying he's going to sell gold, so gold coming under pressure, and buy the dollar. I don't think he's actually going to do this, but if you want to talk about currency manipulation, I don't think the States is anyone who can now discuss or even talk upon the topic after what they did just yesterday. So a bit of dollar strength seeping into the market, but looking at sort of where we're positioned at the moment, Sam's going to be on in just a moment, as soon as I just finish up my wrap to do the technicals, but we did sort of see some sideways trading in the euro for a while, going higher, then that breakout, then this dollar strength, but really we're just back to where we were trading earlier in the week. So the dollar really hasn't been the big mover this week. We've seen bouts of dollar weakness, bouts of dollar strength. That sort of now started to subside. However, the equity market, I mean, this is something we haven't seen for a period of time, is the equity market is just continuing to drift lower. We actually now experience days of so-called risk off, something which was just not prevalent in the market for a considerable amount of time. We have a day where the equity market just sort of sells off. But I guess my feeling on this matter is from somebody who was looking to sell the equity market from at least the first half of 2017, and obviously that didn't work out very well. But I think the market is still complacent to risk, and there are other indications to this. People who were bearish the equity market, in the end of the day, you see lackluster selling to this very day. The only thing which has been able to spark any real risk off, any real move lower in the market, was inflation fears. And why is this? So if we have a look at these risk off moves we've been seeing recently, maybe around here, on the back of economic and political instability, comparative to the move we saw here following the inflation fears, they're minuscule, and this is just goes on to explain market participants' complacency when taking on risk, because in the absence of inflation, what are we comfortable with? Why are we so unwilling to sell equities? Well, we're willing to not sell equities because we believe that central bankers will step in, as they have done again and again and again repeatedly. Whilst in situations like this, where the equity market sees some sustained pressure, this is because, this is talking about the kryptonite to central bankers' ability to provide accommodation. And this is inflation. So these charts still basically tell me that what we're seeing in the equity market and the global markets is still, even though we're coming off incredibly loose policy and we've started to tighten quantitative easing globally and shrink our balance sheets and bring interest rates up, the markets don't believe that the central banks will be unwilling to reverse any of these decisions in the drop of a hat, because they're still complacent about risk. And the only time they are willing, or they get worried, is when they believe the only thing that stops central bankers from being able to accommodate, which is inflation fears. Because if inflation starts spiking, well, then the central bank will surely hike interest rates and ease accommodation aggressively, because they will believe that's a lesser of two evils. Let the equity market fall, let the consumer get pinched, we need to fight this inflation before it becomes a serious problem which can't really be resolved. So just have a look at it on the charts. We're seeing an article in Bloomberg this morning. Let me just find the correct one. Okay, yeah, so this is them looking at, are the markets still complacent? What we're seeing is yields remain elevated. This is looking at sort of your 10 years and the shorter end of your curve, with the Fed hiking interest rates causing at least the shorter end of the curve to rise. And even looking at the 10-year, we were seeing a flattening of the yield curve initially during the year, where the 2-year was going up, the 10-year was staying flat, as people weren't pricing in any inflation or growth in the sort of longer term. But if you see the 10-year yield has been rising. It's approaching that 3% mark. It has become a little range bound at the moment. But this is on the back of tightening policy. And if you have a look at index to treasury volatility is continuing to go down. So this is people saying, yes, we're tightening policy, which should in the end bring about volatility or less accommodation, meaning that the market will not feel so comfortable at these all-time high levels and will become a bit more sensitive to economic risk and political risk. However, that isn't materializing. We're seeing that yields are rising, but volatility relative to the treasury is still on the way down. So I think this might... What's going to reverse this? I think what's going to reverse this is when we finally see a real risk-off move materialize, whether that's North Korea, whether that's more economic instability, or a deterioration in the Brexit talks having sort of ramifications on global equity markets, and central banks abstain to intervene. At this point, I think this complacency will start to unwind and people will start to price in risk, which, given where we're trading, even now, equities are at all-time highs. If we look at the NASDAQ, the S&P, yes, a little bit lackluster here, reversing about 50% of its sell-offs. But if you look at it on a longer time frame, I don't think, we need to be too concerned. We're still right at the top of the move. Only 2 years ago, we were trading down here at 1,800 almost. Now we're trading at 2,800. So we're still at the all-time highs, irrespective of this bout of risk-off that we received. But if you have a look at the NASDAQ, well, the NASDAQ being the outperformer most recently, it went on to push all-time highs in the face of all these risks. So complacency is something we still have in the market. I think this equity market, if we start to see inflation, and that's it. That's the only thing worth talking about when it comes to the equity market. Is inflation coming up? Yes. Okay, sell equity. If inflation is staying low or subdued or not picking up quite quickly, fine, wait, buy equity. Now, we've had the only real risks were the economic instability with Gary Cohn and Rex Tillerson, but now even if somebody else gets fired, well, this is the third fire and we got over the last two, so what? Let's move forward. If we can survive without Gary Cohn, who's who's considered to be a steady hand on the pump, and if we can survive without Rex Tillerson when America's going to go speak to North Korea, well, great. Those are two very powerful people in Trump's administration, which have now been put aside, cast aside, and the markets have basically recovered. Look at the Nasdaq, all-time highs. We're talking about trade wars with China. China is a huge technology producer and still one of the largest producers in the world, and the Nasdaq is still at all-time highs. This is a complete byproduct of accommodation in the market, not willing to price in any risk. So I'm not saying we're going to fall imminently, but equity markets are still, I feel like, in a position of risk. Now, that being said, I'm not recommending a buy just yet. In terms of the equity market, I feel we're going to be range bound. We're probably going to trade sideways. We had the opportunity for the S&P to rally, and as the Nasdaq broke higher, I really thought the equity market was going to make a push. That didn't happen. That didn't materialize this week, given further instability in America. So the next thing to take into consideration is then your Fed hike, which is scheduled for next week. Fed Watch tool. So we have a look at 21st of March. We were, last time I was on the mic last week, this was 88%. Now we're looking at 91.6% for 21st of March. So that is next Wednesday. So the market is fully priced in this upcoming hike. So it's not a situation where just buy the dollar if we see further commentary coming out of the United States or Larry Kudlow, then yes, possibly. But I think markets are going to just stay largely range-bound at the moment, given the fact that we are basically fully priced in. I wouldn't be surprised over the next coming days, Monday, Tuesday, this gets up to 100%, which then sort of negates the volatility we'll see following the rate hike. So that's something worth taking into consideration when approaching today. I wouldn't be surprised if market participants just take it easy today. Just having a look at the market, actually, we're seeing the DAX push for session highs as I'm speaking. Okay, let me just have a look at a couple other articles. Sorry, so another article here was BlackRock. So BlackRock is ready for a big move in the pound. Direction doesn't matter. So having a look through this article, it seems that BlackRock is just saying that that sterling has been really not trading with much vigor in either direction. However, there are huge risks to the downside, and there is huge potential to the outside, given the fact that we're coming to such an important point where we're starting to discuss this transitional deal, and it's all coming to a head at the moment. If the transitional deal goes through smoothly and the EU and the UK sort of compromise and come to an agreement, then well, great, that's going to be extremely bullish sterling. Vice versa, if this sort of negative rhetoric continues and the transition deal gets thrown out the window, well, that'll cause sterling to go down. But whatever it is, it's sort of decision time now. The matter is becoming pressing. It's 1 year now since we triggered Article 50. Something needs to move. Now, because this market could now go higher or it could go lower, what BlackRock has done is they've put a straddle on sterling. What does a straddle look like? Well, that just means they are expecting a big move, higher or lower. So it's just trading volatility. What they're saying here is they've got long puts below this strike price, which means if the price goes below there, they will start to make money, and they've got long calls above this price here, just around the 1.5, and that's the pre-Brexit highs, if we remember correctly. So this is Brexit here. So in between this, in this zone, they're paying a premium. Now, if the market finishes, I don't know what their expiry is actually, but whenever the expiry is for, if the market stays trapped between these prices, well, this costs them a premium and they make no money. If the price, however, reaches this upper bound, well, the price that BlackRock paid for the long puts and the long calls is going to be met, and they will start to profit, vice versa on the way down. If they break out of here, their long call goes in the money, offsetting the premiums they paid for their long calls and long puts. So basically, BlackRock expecting a bit of volatility, and obviously being one of the largest asset manager in the world, this is something the market will be looking at. So have these sort of levels marked up. This 1.34 and the 1.48. A break of that, market participants will definitely be interested, and if we may actually see some pinning effects going on as the market tries to drive to either side of this. Okay, just another point I wanted to talk about was one of the favorite products in the world. We got the Bitcoin chart here, and if anybody's been watching Bitcoin, let me just pull up a chart of this product. BTC. And Bitcoin has not been having fun recently. Actually, ever since the futures contract was created, the Bitcoin has not been having fun. It's just been going down and down and down. But quite recently, you saw some heavy selling pressure, and this happened predominantly on Wednesday and Thursday. No surprises there. This was following the US equity market breaking lower as well. So again, just reconfirming this concept that Bitcoin is the ultra speculative product. So if we believe equity markets are risky, well then Bitcoin is ultra risky. So if we sell equity, we sure as hell are going to sell Bitcoin as well. So just reconfirming this correlation. Having a look at the article here is showing, oh, I don't know which screen I was showing. Okay, this one here. And this is just showing that we're coming up to a moving average cross here. So we got the 50-day moving average and the 200-day moving average. So this would be a death cross if this occurs. A death cross would be a signal that this is going to result in further bearish price action. This is sort of your most watched by institutional large-scale investors looking at crosses, and I'm sure the market will be speaking a lot about this if it does happen. So your retail market maybe not looking or as familiar with these two particular moving average crosses, but sort of investors and longer-term traders will definitely be looking at this, and especially if it starts to gain momentum in sort of your financial press, then that'll be something worth considering. So if any of you cryptocurrency traders are out there, just be careful and keep an eye on this cross. If that does occur, I think Bitcoin still being the lead would result in a reduction in prices across the board. Sorry guys, just quickly give me a why if the screen is still coming through. This one here, my apologies. So this is the one I was looking at, bearish resistance. So this is the 50-day moving average and the 200-day moving average looking to converge, and if they cross, that would trigger off a bit of downside in the equity market. Okay, let's have a quick look at the calendar as well just before I hand over to Sam. So today we are getting final readings for your European inflation. So EA inflation, this largely I'd classify it as higher tier 2 data. You can't say inflation is lower tier 2. The reason I'm saying it's not going to be that market impactful is that we have inflation rates for February and it's the final reading. This does not mean you can hold any positions, but manage expectations coming into this. This is now February data. It's a final reading. We've had the regional components. We've had Germany report. We've had Spain report. So I wouldn't be expecting great market moving events, but I would absolutely go ahead and prohibit anybody holding any positions irrespectively over this data. So bear in mind, given the fact that inflation is still one of the biggest talking points for central bankers across the globe. Let's just have a quick look at the numbers. Let's look at our year on years. Let's look at our core first, actually. Core being the real market, which doesn't, the inflation rate, which really hasn't seemed to go anywhere. This is looking at it on a year. So from our 0.7 lows in April, we got to 0.2. That's been the ceiling this year. And otherwise, the average inflation rate has been around 1%, which is not great. You really want to see broad-based inflation around 2%. Well, in EU, it's like just below 2%. But consensus is for no change, so we're expecting inflation rate to stay at 1%. And looking at your inflation rate headline, this again, final reading for February. Well, look at European inflation. I mean, how long can Draghi write this off? Good on him that he has been writing it off and he has been turning more hawkish, but I'm a bit concerned here. If we see European inflation continue this trend lower, I reckon we could start seeing bouts, not maybe on this number, but future numbers, especially preliminary numbers. If it's a consensus for a reading of 1.2, so we're expecting it in line, but if we start getting a number of 1.1 or even 1, well, when does Draghi start to recognize this and start to appreciate that maybe this tightening of financial conditions, irrespective of what your sentiment and numbers are saying, is having a material impact on demand from consumers, therefore resulting in lackluster inflation. So I mean, European inflation, I really hope it picks up personally, but who cares about that? This trend will need to break, and if the trend breaks, I think we're going to start seeing significant strength in the euro, but more importantly, if we see confirmation, if we start seeing inflation go towards 1.1, 1% or a break below 1%, I think that is undeniably going to have to be represented in the next communication from ECB's Draghi. So important numbers, I wouldn't be complacent, but given this trend that we're seeing in the headline inflation, I'd be careful. This may be an area of risk. And just to quickly wrap up, we're going to look at the month-on-month as well. More volatile doesn't exclude your seasonality changes, so you can see quite volatile here. What are we expecting? We're expecting a consensus view of 0.2, so a pickup of our minus 0.9 in January, but that's understandable given the fact that that's coming out of December into January. People are a little bit poorer anyway. Spending goes down a little bit, but expecting a little pickup back into sort of our, I'd say, lower end of the range. Actually, that would be about consensus. So we're not really expecting a dramatic move either way. Just flicking through the rest of the calendar, we have some sentiment data coming out later on. So we have building permits, not going to be market moving. Capacity utilization, manufacturing production year on year for the month of February, industrial production year on year for February. But then, so these are of importance for sure. Again, February readings now midway through March. So quick flick through these. Okay, so no percent. So previous reading of 3.7% here. So if we continue this upward production, well, this then reconfirms the United States economy is continuing to grow. In terms of equity markets, as I said, we've got the Fed decision later on this week and later on next week, midweek next week. So, I mean, equity markets are maybe a difficult market to trade, and today as a whole may be difficult to trade. But if there is going to be any surprises in the equity market, I would say very difficult to say. Equity markets are sensitive to sentiment data because markets are driven, well, equity markets are driven by sentiment. How bullish are market participants feeling? How bearish are market participants feeling? So sentiment data is quite key, but given the fact that if we look at it on a 5-year or a 10-year, the market is desensitized to a strong number. We've been trending up pretty steadily. So if we have a look at expectations, our consensus view is 99.3. 99.3, no doubt, puts us still right up here at 12 months highs. So maybe this would spark a bit of a recovery or a fall, I'd say back below 95, hitting the 93 level, may see a continuation. So we're really looking at two extremes here. Above 100.7, then we may see equity recover just slightly. But I think if we started to read around 93, 90, etc., that would result in the equity market selling off a little bit more, and that may be a bigger opportunity. Until then, guys, I'd be looking to avoid the equity market, manage expectations coming in today, and I'm going to hand over to Sam to check out the technicals. Thank you very much, guys. If you have any questions, do drop it in the chat.
Hi guys, we'll just have a quick look at the charts going through their price action this morning and what could happen for the rest of the day. If we just have a quick look over at cable to begin with, just push through the pivot here quite aggressively, breaking through the higher of the day, then the pivot offering a good level of support for that push higher, even breaking through now. Actually, what was quite a key area of support turned resistance late last trading session. And R1 not too far away as well. Key level to the upside. Obviously you can see here this on this 15-minute chart, but the high of yesterday, quite a clear level of resistance that I would keep in mind as well. Looking over when looking at cable, to have a look at euro pound as well. Just put some longer time frames to clear it up. Actually, let me just go straight to the CFD to make it a bit clearer. You can see euro pound as well, just pushing to a new low. If we were to come back to test those previous lows from yesterday, could be a decent area of resistance for that trade. For those looking at euro pound as well, I'd have this sort of trend line drawn on as well. As you can see, this is where the move really did start to have a look at breaking yesterday's low. So euro pound just pushing to the low, cable as we speak just having a go at the high as well. So pound is strengthening a bit this morning. Having a quick look over at euro. Let's just put this on that longer time frame. Low of today, pretty much the low that we saw on the 12th. So again, keeping an eye on that. If we break through, it wouldn't take too long, you would imagine, to get through to the 11th low that we see. I think if we were to come back towards the pivot, let me just lower the time frame. I think it's almost a shot in the dark whether to go long or short at the pivot. I think waiting perhaps for the actual market level above 124.26 on the futures looks a better opportunity than going in, but definitely full size anyway at the pivot point. Probably worth getting a bit of a trend line on here as well. In terms of the euro, well, for the morning, obviously, as Saif said, you have got the data out in 50 minutes or so. Just over. While I wouldn't be expecting it to do too much being a final reading, probably worth sort of sitting on your hands perhaps for any euro related trades. DAX just pushing higher this morning. Obviously there was an issue with Eurex, but it seems to all be have been sorted now. Trending higher. We'd probably get a trend line on those lows if we were to get a bit of a retracement back down. Obviously we're now trading the June contract for the DAX, so that's why on the left hand side the data isn't the best. Although looking at a daily continuation obviously will help clear all of that up to some respect, but still quite choppy there as well. Nasdaq caught my eye this morning, as you can see. Got a series of lower highs. Let me just see if there is any sort of trend you can get on here. Yeah, it's not too bad. So be looking for any potential retest of that, and it could well coincide with what is the high of the day at the moment. Also though, quite interesting to see that yesterday we had a failed test of that low that we made very early on. Again, probably worth getting a trend line on that just to see for later on if we do get a test. So we're just perhaps getting squeezed in. Could be an interesting one as we look at the Nasdaq here on a weekly chart. And just remove all the studies. You can see obviously we pushed to that new all-time high not too long ago. It'd be interesting to see where we close the week, I would say. So definitely an interesting time for the Nasdaq, whether we can actually perhaps break out of this mini sort of range to the downside that we're in. I remember speaking earlier in the week just how important the low from, it was Monday's low, wasn't it, the 12th, yeah. We were saying just how important that was for many markets, and it got up, just couldn't really confirm to push the upside, and since then has come back down, and we're trading where we are now. Same for the S&P. You see that Monday low just couldn't really break above. The Dow Jones Monday low, I mean, it was a bit slightly different there, but same sort of thing. It just couldn't get a confirmed push to the upside, and since then we've sort of been ranging down. Again, for all these equity markets, I would be looking for just these sort of highs to draw some sort of trend line on those, as well as the lows, just to see if we can get squeezed in and then look for a break either way. As for, well, today and the next week, the cash open's still going to be 1:30. UK clock's not changing to the 25th. So data in the US, as usual, will still be, well, not as usual, usual for now, will still be a bit an hour earlier. Have a look over at oil, which is pretty messy. I would leave the pivot alone. More importance perhaps to the low of the day. The range that we're in, I would really focus on sort of 40, maybe even 41 to the upside, and then 19, and then even then you've got quite a few sort of spikes of what could be support. So oil looks quite messy from a trading perspective, or getting in right now. I'd say it's better to sort of perhaps wait for a break either to the well, I would prefer to the upside above 41, and then sort of targeting really the R1 level and what is the high from yesterday, pretty much on the same point. And again, while only having those two tests, could well be that the third one looks to come in around there as well. So definitely something to keep an eye on going forward there. We'll have a quick look over at gold, which caught my eye earlier as we're coming up towards the pivot area, which was also the high of yesterday evening. Lower the time frame down, you can just see how that reaction from this point, let me just get the rectangle, was quite significant. One test, two tests, and we just hit that now along with the pivot as well. The dollar just coming under a bit of pressure, the lowest it's been this morning for the day. So if that was to continue, and the dollar was to perhaps weaken a bit more, you could see gold perhaps pushing through. In terms of levels to the upside, you have this whole area where we sort of found a bit of a pullback last night, but for me the point of interest is this sort of area around here, 13.22 for gold, and that will be a point in the market that I'd be looking for as a key level of resistance. To the downside, you can just see how important the low has been, once, twice, 3 times there as well. Really key area of support, one to bear in mind going forward for the rest of the day in the trading session if we were to perhaps break out of that on some more dollar strength or something like that. And then S1 wouldn't be too far away from that, and then it does open the door again. So gold, interesting at the moment, but also I feel if we were to push a bit higher or get another test of those lows as well. Have a quick look over at pound just to finish to see, yep, you can still see pushing on. So R1, the next key area before the highs of yesterday, also going to be pretty interesting as well. And again, I would be looking to get a trend on all these markets at the moment. Just perhaps made, let's remove that level there, lower highs as a key sort of point of interest to see if we can look to break through and then break out these ranges that perhaps we have been in. Also for pound, it's a bit more messy, you can see here, but those lows as well being quite well respected. Any questions as usual, please get them in the chat. And for all our Irish listeners, happy St Patrick's Day for tomorrow, and I hope England ruin it for you in the rugby. But if not, have a good weekend, and I'll catch you later on.